Account structure decides. Ideology doesn't. Most retail Bitcoin investors choose between an ETF and direct ownership based on what feels philosophically right. ETF feels like real finance Bitcoin. Direct feels like real Bitcoin. Both are wrong reasons to choose. The right reason, the only reason that actually compounds across decades, is the account structure you're holding the position inside. I'm Rachel from ChainSense. In the next 5 minutes, 3 things: what each wrapper actually owns, 3 jurisdiction scenarios that decide for you, and when the right answer is to hold both. Start with what you actually own. A spot Bitcoin ETF gives you a share. The share represents Bitcoin held by a regulated custodian. Coinbase custody for the largest US ETF. Others vary by issuer. You don't have keys, you don't sign transactions, you don't have an on-chain presence. You have a security in your brokerage account that tracks Bitcoin's price minus a small annual expense ratio. Direct ownership gives you a private key. The key controls coins on the Bitcoin blockchain. You sign transactions yourself. You bear full responsibility for backup, security, and inheritance. You have Bitcoin, not a security that tracks Bitcoin. Here is the practical implication most retail investors miss. The ETF gives you exposure inside whatever account holds it, including tax-advantaged accounts that cannot legally hold direct Bitcoin. The ETF's wrapper is its purpose. Direct ownership gives you sovereignty, the ability to move, store, inherit, or use Bitcoin without permission from any custodian or platform. Direct's wrapper is its absence. Different products, different problems. The investor who treats them as the same thing is the investor who picks the wrong one. An ETF gives you Bitcoin's price. Direct ownership gives you Bitcoin. 3 jurisdiction scenarios decide which wrapper is right for you. Scenario 1, United States. A Roth IRA can hold a spot Bitcoin ETF. The 2026 contribution limit is $7,500. Tax-free compounding for 30 years on a volatile asset is a different outcome from doing it taxably. Direct Bitcoin cannot legally live inside a Roth IRA. If you have IRA room, the ETF wins by default. No direct equivalent inside that wrapper. Scenario 2, United Kingdom. The picture changed on April 6, 2026. Crypto ETNs were reclassified from the Stocks and Shares ISA wrapper to the Innovative Finance ISA only. Existing pre-April 2026, Stocks and Shares ISA crypto ETN holdings stay where they are. New crypto ETN purchases must go through an Innovative Finance ISA, and most mainstream UK brokers don't offer one. As of late April, only one platform supported the combination retail investors actually need. Verify availability before you set up. Scenario 3, non-US, non-UK. No tax-advantaged wrapper for crypto. Both wrappers taxed equivalently. The decision shifts to custody preference and platform fees. Direct usually wins for anyone above a custody threshold. Your tax structure decides the right answer, not your views on self-custody. For most retail investors with meaningful position sizes, the answer is not ETF or direct. The answer is both. The framework. ETF goes inside tax-advantaged accounts where the wrapper benefit compounds. Roth IRA in the US. Innovative Finance ISA in the UK if you can find a platform. Direct goes outside the tax-advantaged accounts above a custody threshold. Above $1,000 belongs in self-custody, not on an exchange. This split captures both benefits. You don't have to pick a side. 2 practical considerations make the split work. First, prioritize the tax-advantaged room. The ISA or IRA contribution limit is the binding constraint. £20,000 in the UK, $7,500 in the US for 2026. Use those allowances first every year before anything taxable. Second, custody discipline applies to the direct portion. Hardware wallet above $1,000. Metal seed backup above $30,000. Multi-signature setup above $200,000. Optimizing both legs. Wrapper protected ETF inside. Custody disciplined direct outside. Captures both compounding benefits. 3 things. Account structure decides which wrapper is right, not ideology. The right answer for most retail investors with meaningful position size is both. ETF for the tax-advantaged room, direct ownership above the custody threshold. Use the allowances every year. Full Bitcoin investing framework for 2026 on the Channel Hub video, link in the description below. Wrapper isn't ideology, it's account structure. I'm Rachel. See you in the next one.